Mike's a wily old veteran. He's been around a while.
Wait, he wants to change.
He's
his
been
mind.
an accountant with Brink Sadler for the last 37 years. Is that about right?
That's pretty close.
Jeez.
He was a Army veteran that served where?
He still is an Army veteran.
Yes, thank you.
I served in Vietnam, but
In Vietnam. And
Been married
he
for
lives
a
in
long time.
Yelm, right down the street from the
Firing range.
the Ramthas.
Wow.
in the backyard of the firing range, yeah.
Yeah.
Wow.
Ladies and gentlemen, Mike Stevenson.
Thank you. That was a very good abbreviated story. I thought I would start with my education, because it was so simple. I started out going to school when I was in the military. So I went to Monterey Peninsula College for a little over a year. Then I went to Golden Gate University out of Presidio for 3 or 4 classes. Then I was shipped to Kansas. I went to Kansas State for a couple of classes. Then I went to back to Fort Lewis and ended up going to Fort McCoy, Wisconsin. So I went to the University of Wisconsin at La Crosse, which was 110 miles from where I was stationed. And it took 4 classes a week. And then from there I went to Germany for 3 years and went to University of Maryland. Then I came back and went back to Fort Lewis and was at the NCO Academy teaching. And I went to Columbia College and finished my undergraduate degree after 10 years. Then I started my master's degree at UPS, was halfway through, and the Army decided I should go to drill sergeant school and be a drill sergeant. And that was not one of my goals in life. I did not want to be a glorified babysitter. Had been in a BCT unit before, so I didn't want to do that, so I declined the invitation to go. And what they do is they bar you then from continuing, which I knew they would lift because I was in the top 2% of the Army at the time in my grade. And so after I got almost all the way done, it was time for me to get out. And they said, well, we'll let you stay in, but you still have to go to drill sergeant school. And I said, no, that's okay. So I spent 11 years active and then 13 years in the reserves. And the whole time in the reserves, I was teaching basically. And I was teaching mortars, which is a long way from this, from being an accountant. But at the time, when I was active, I was probably one of the top 10 people in the entire US in mortars as far as all the classes I'd had and all the things that I taught. So that's why I ended up teaching. And I was tried to recruit me by Delta Force twice and a few others, and I just wouldn't do that to my wife because she'd kill me in my sleep. And it is true. They just disappear. They can't tell anybody. So it's not very good for marriages usually. Anyway, after all that, I ended up becoming a CPA. So I'm a CPA, and then I decided I wasn't good enough, so I got a CMA, which is similar to a CPA except it's for major corporations. So, and it was a big thing on the East Coast. It's also a 3-day test that you take, and it's very complicated. And then lately they gave us they came out with a new one. It is Chartered Global Management Accountant. And so I received one of those, but fortunately I didn't have to take the test. Because I had all the experience and all the other stuff, when they first come out, they usually will issue them to those people that have that, and then anybody after that has to take the test. which I'm not sure how long that test is, but I'm not going to take it. And all of those certifications also come with some continuing education that you have to do. So we have to do like 40 hours every year to keep up on our courses. And that's one of the reasons that CPAs are usually more educated and more up to date on things that you get, or tax issues, because they have to go to school all the time or they lose their license. So that's one of the things you should always look for. What else? Oh, I did miss one of the schools. I also went to Golden Gate starting in around 2010, I believe, and got my master's in taxation. So I also went and did that, only because one of my partners had one and I was tired of him telling me that. So you can continue to go to school your whole life, and you probably should. A lot of people think, well, I'll just go get it over with and be done with it. But you really should, make it a lifelong thing that you're going through. Find something else you want to you're interested in, and just go. A lot of people think they can't do it. But believe me, anybody can do it. Just a matter of going and doing it. Today I was looking and trying to figure out what to talk about, and then I thought about this tax season, which was pretty hard for us. We hired 5 new people, and one of them worked out. One of them was really a superstar, one was just so-so, and a couple of them were just disasters. We spent more time teaching them than we did. We could have done the returns ourselves, basically. But that's the way it goes, and sometimes they catch on later and do better, but it just made it a really tough year for us. So one of the things that came up, my clients asked me a whole lot. I bet I had 20 to 30 people ask me about this new form, the 1095B. Everybody wanted to know what to do with it, and tell me I didn't bring it here. Oh, yes, I did. I don't know how most of you, if you have insurance, should have received one of these things. It looks like that. Okay. Or it can look like this. And all this form does is verify whether or not you had health insurance for yourself and your family for the entire 12 months. And that's what the little check boxes are. If you weren't insured for the whole 12 months, they check the little boxes to show when you were and when you weren't. You don't send this to the IRS. It's just your proof that when you check the box in the tax return that says, hey, I had health insurance for the whole year, so I'm not going to get penalized this year, then that's what it's for. So you just keep it in your record. You shouldn't throw it away. You should keep it with your records at least for 3 years.
So if you're audited.
Yes, in case you're audited. Exactly. Now you could prove it other ways, I'm sure, but this is the easiest way, and this is what they're going to want you to look. Some people also receive this same form, but it's a 1095C. And what that one shows is it shows what your premiums were. It shows what the second lowest premiums would be for an average person, and then your payments and what your discount was. And at the end of the year, most people think, this is great. I paid $1,500. I had a $1,500 deduction for this year's health insurance. But what happened is when they went in and applied for that, they said that they were going to make $15,000 that year. At the end of the year, when they do their tax return, all of a sudden they made $20,000. So what happens is that discount gets added back to their tax, and they end up paying back the whole $1,500 in a lot of cases. Matter of fact, I've only done 2 or 3 because they weren't clients, they were other people, and all but one of them had to pay back almost all of it. Because it's natural, and when you know you're getting a discount, people say, oh yeah, I don't make that much. And they come up with a number that's way lower than what it should be. So they got away without paying it during the month, but they got hit in the end. Also about that health insurance, there are penalties for not having it. Hopefully nobody's here is going to get that. And I was going to just go over that briefly. It's 2% of the amount of your adjusted income over the table amount. So if you had 2 adults and 2 children, that amounts $10,200. So if you made $70,000, you just subtract it and you take 2% of that, and that's $988. Then there's another way of determining it, and that's by the dollar amount, and that's was $325 for an adult times 2, and then $162.50 times 2 for the children, which was $975. But the kicker is, you don't get the lowest one, you have to pay the highest one, up to the limitation, and the limitation was $207 a month, which comes out to $2,484. So you never have to pay more than that, but of the 2, you would have had to pay the $988, which is about $82.33 a month. So for some people, they're thinking, hey, that's still a better deal.
Isn't that tiered, so next year is it gonna be higher? You know?
Yes. That's what's gonna happen. They're gonna keep going and make it unless we get some Republicans in there, and then this may disappear.
Where does that money go? Just into the same?
Medicare.
The rest of the taxes? Oh, it goes into the Medicare fund?
Yeah, I'm pretty sure that's where it's going, is in the Medicare. Everything they try
You're
to,
paying for you're a young person who doesn't want health insurance, so you're being fined and it's going to pay for older people's insurance.
I think we call it socialism.
Yeah.
Yeah,
So don't vote for Bernie Sanders or Hillary, because you will get that.
yeah.
So you want us to vote for Trump? Is that what you're saying?
Anybody but those two.
Isn't the system just so stupid though? I mean, what they're doing just can't work forever, right? I mean, it's a compromise that's just a joke.
Nothing's designed to work forever.
Well,
They just keep adjusting it as they go along, and then whatever the next guy wants, he kind of molds it his own way
why don't we
as they
just get it
go.
over with and have universal health care?
Well, that's kind of what this is supposed to be.
It's not, though, it's crap.
That's true, but that is where they're trying. Some of the people are going that way. The second most thing I get asked is about estimated tax payments. Does everybody know what estimated tax payments are? Okay.
Yeah, buddy.
If you have a W-2 wages, everybody knows that they withhold your federal income taxes from your wages. And that's mandatory. There's only a couple ways you can get out of it, but generally you're gonna have it withheld. Okay, that's the IRS telling you that they want their money up front. They don't wanna wait until the end of the year and find out you don't have the money to pay them. So they, years ago, decided to start taking it out. Well, there's lots of people that don't get a W-2. They they have businesses like most of you in this room, and so what they have to do is make estimated tax payments. The idea is that you will pay in 1/4, basically, of your income, of your tax on the income that you earn every quarter, I'm gonna say, but actually it's not exactly a quarter. It's April 15th, June 15th, September 15th, and then it goes to January 15th. Those 4 periods. So they break it up. If you miss it, even by a day, any one of those, then you could be penalized for that quarter. Because, they're trying to make it up. The exceptions are, go ahead.
I was just gonna ask, why is it after 3 months at the beginning of the year, and then after 2 months for the next one? You're supposed to pay a quarter's worth of tax after 2 months worth of earnings.
Actually, if you think about it, it's 3.5 months, and then it's 2.5 months. No, then it's 2 months, and then it goes to 3 months, and then it goes to 3.5 months again. No, 4 months. Just the way they set it up so you can also use annualizing. And one of the things they did determine, if you have a partnership, an S corporation, those type of businesses that go into your returns, that money doesn't count until the end of the year, as of the last day of the year. So you don't have to guess what the income was on that in the first quarter, the second quarter, or the third quarter. It basically all comes out in the fourth. We do put it throughout the whole year and figure it out that way. But if you end up with a penalty, then we can annualize it and go back and put it in the correct periods, which are really strange, because they're like 3 months, 5 months, 2 months, and 3 months again or something. But anyway, there's some calculations that go in there. The underpayment penalty is basically interest is all it really is. Paying for whatever period of time you were underpaid. And the safe harbors are 90% of the current year. If you paid in 90% of the current year, you don't have a penalty. If you paid in 100% of the prior year, you don't have a penalty, as long as your income was under $150,000. If it's over $150,000, you have to pay in 110% of the prior year's income to be safe, to be in the safe harbor. And if you underestimate it by more than 20%, they can actually attach another penalty on top of it. It's like 10% of the tax. So none of those are good to have. All right.
Do you guys have a lobby to lobby the US government to make sure that the tax system is this complicated?
Yes, we love it. I don't think it'll ever, even if they went to a flat tax, there would still be lobbyists that would figure out ways to get some kind of a break for major corporations and for large individuals. And so there'd still be CPAs trying to figure that out. Plus, they'd probably make the estate tax laws worse, or the trust laws worse, or something, so that there would be still more than enough work to do. And the problem with the flat tax is that it penalizes the poor, basically, or the lower income, because they pay a much higher percentage of their earnings than a wealthy person would. So that's one of the reasons.
I was watching Ted Cruz campaign rally for about 3 minutes before I vomited. And he said that he wants to abolish the IRS so you can send your taxes in on a postcard.
You know, they've talked about doing your taxes on a postcard for 20 years.
So that's campaign rhetoric nonsense, of course. But
Well, there was a few years ago, 5 years or more, there was a deal that came out and said, let the IRS calculate your taxes. They'll just take whatever information forms they have, calculate your tax, and nobody would have to file anything. But nobody wanted to leave it to the IRS to calculate their taxes. And of course, you can do that now. If you refuse to file, that's actually what they'll end up doing. They'll take the information they have with no deductions and go ahead and calculate your tax, which is similar to a flat tax. That's what a flat tax would do. They take your gross income, not your net, and charge you on that, kind of like sales tax is now.
will they give you the standard deduction?
They wouldn't have to have a standard deduction. They wouldn't have any of that. They just say your gross income is this much, flat tax is this much.
No, I mean, if they do your taxes now. without
Yeah,
filing.
oh yeah, they'd give you the standard, yes, that is true.
Will they
No.
also fine you for not being insured if you didn't send anything in?
I don't know, they might. Yeah, they might, They'd probably ask you. Right now, or at least last year, the IRS didn't have the power to collect on that health insurance tax, which was kind of weird. They could assess it, but they couldn't collect it unless you paid it in. But they couldn't force you to pay it in. So that one I think they're still working on.
My question about that though is, if they are serious and think that you can get rid of the IRS, who is actually physically collecting the taxes?
The government, somebody in government, that's, nobody knows. Treasury, US Treasury would do it. Same people that do it now, really. It isn't the IRS that collects it, it's the US Treasury that collects it. All your checks when you write them out,
Okay.
a lot of people write IRS, but it should be US Treasury. And that's, somebody there would end up having to do it.
They would process the postcard.
So you really would just be changing the name of the IRS to something else. That's all you'd end up be doing, you know. So all those guys would get fired from the IRS and be hired by the US Treasury probably, because they need all that experience.
Well, if they did that, wouldn't that put you out of a job?
No. I could go be a treasury man. And I wouldn't worry about it anyway. At this point. That's right. I could go to Iraq. I could go to Afghanistan, Iraq, any of those places and make at least $100,000 a year.
Do their taxes?
No, teaching them mortars.
I thought you were gonna do taxes for the Taliban.
Yeah, actually, I had an offer years ago when I first got out to go to Iraq, I think it was, and teach accounting or do some accounting work, but at the same time, if they had ever found out what I knew, that'd be the end of it. I'd be lucky to come out alive, so that's why I didn't take that. Exactly. The other new taxes that came out was the Medicare tax, which was an additional Medicare tax, which was 0.9%, which is pretty low, but it was all earned income over $250,000 if you're married and $200,000 if you're single. So not everybody got hit by it, but a lot of our clients ended up getting hit with that. Not as many as you'd think, because most of them are retired and have income from other places. The other tax is a 3.8% investment tax, and that one is the same parameters, anything over $250,000 and $200,000 for singles. And it basically looks at your interest, your dividends, your rents, your royalties, your income from S corporations that are not businesses, and your partnerships that are not businesses. All of that income that's over the $250,000 mark would then be taxed additionally 3.8%.
Your modified adjusted gross income.
Right. And so you have to go through some different levels to figure out exactly what it is, but it's there. And capital gains. Capital gains from sales of stock and capital gains from, what am I thinking of? No, this is just on stocks. It would be, capital gain dividends. Yeah, dividends, capital gains. So,
Dividends are gonna be changed this year, right?
what do you mean
The way
change?
that it's taxed?
Not that I know of.
Okay.
Not yet. Are you, now which kind of dividends are you talking about? Are you talking about dividends from like corporations?
Corporations, that's
Yeah.
corporations.
See, a dividend from an S corporation isn't taxed at all. From a corporation it is, and right now it's still at the 15% bracket. But if you get enough of it and it's over the $250,000 with all your income, then it's going to be taxed at the higher rate.
It's not taxed at the corporate level, but it is taxed at the personal level.
Right, but it's also not a deduction at the corporate level. See, that's why they call it a double tax, because the corporation gets taxed on whatever they make, and then if they don't pay you a salary, which would reduce their income, they decide to give you a dividend, the dividend goes out to you, no deduction to the corporation, and you pay tax on that same money again.
But no Social Security.
But no Social Security, right? So that's kind of the differences. And of course, most of the capital gains rate are up to 20% now, and the maximum now is what we call 23.8% because if you're over the 250 limit. And those were pretty much the only points I was going to talk about, unless somebody had some other questions.
That's taxable income you're talking about?
Yep. No, some of it's adjusted gross.
Where do they get the, when you can write off, or if you do repairs on something, and that you have to schedule it out over like 27 and a half years, where do they come up with these numbers?
Some
Same place
actuaries that
59
came
and a
up.
half for your retirement, 70 and a half for your required minimum distributions.
Right, it's just, they have these analysts that go out there, probably actuaries that take these buildings and try to determine how long they last. You know, they've changed. Like right now, commercial buildings, 39 years. I remember when you could get by with 17 and a half years. And I've seen apartment complexes at 15 years, residential. So it just depends on what's going on in the tax law at the time, whether they, and what happens when they reduce those rates or those lifetimes, then that market just goes crazy. And it generates more money for the government, so that's why they do it. And it also generates, more money, generates more tax for them. So they go back and forth on what they're doing, and when they're trying to even things out, then they spread those things out further and further. Because if you have a residential building, it's 27 and a half years. So it's much less. And of course, they came out with the new regulations on repair and classified them into betterments and a few other categories, gave fancier names, but basically they're the same thing, and said anything last year over 500, if it would, and it had to be a separate line item, would have to be capitalized. If it was 500 or less and it was a single item, you could deduct it. This year, if you have the election, the safe harbor goes up to $2,500, which will help out a lot more people as far as that. And for rentals and stuff, there is no, there's no 179 for them. Only businesses get the 179 on theirs. Any other? We're good?
We're good.
All right, it's over, thanks.